Hello and welcome to our channel. In this video, we'll be discussing one of the most powerful concepts in investing, compound investing. If you're looking for a way to build long-term wealth, then you're in the right place. First, let's start by defining what compound investing is. Compound investing is the process of reinvesting your earnings to generate even more earnings. It's a powerful way to grow your wealth over time. Essentially, you earn interest on your initial investment, and then that interest earns interest, which in turn earns even more interest, and so on. Compound investing is important for building long-term wealth because it allows your investments to grow exponentially over time. The longer your money is invested, the more time it has to compound, and the greater your returns will be. This means that even small investments can grow into significant sums of money over time. By taking advantage of the power of compounding, you can build a solid foundation for your financial future. Whether you're saving for retirement, a down payment on a house, or just a rainy day fund, compound investing is a great way to help you achieve your financial goals. So, now that you understand what compound investing is and why it's important, let's explore some of the key strategies and tips for getting the most out of your investments. The power of compound investing. Now that we understand what compound investing is and why it's important, let's dive deeper into the power of compound investing. To illustrate the power of compounding, let's consider an example. Let's say you invest $10,000 in an investment account that earns 5% interest per year, and you leave that money invested for 20 years. If you don't touch the account during that time, you will have over $26,500 at the end of the 20 years. That's a gain of over $16,500 just from the power of compounding. Now, let's say you invest the same $10,000 in an account that earns simple interest, meaning the interest is not reinvested. If you leave the money in the account for the same 20 years, you will only have $15,000 at the end of the period. That's a difference of over $11,500. The difference between simple interest and compound interest is significant. With simple interest, you only earn interest on your initial investment, but with compound interest, you earn interest on your initial investment and any interest that you have earned. For example, if you invest $1,000 with simple interest at a rate of 5% per year, you will earn $50 in interest per year. If you leave the money invested for 5 years, you will earn a total of $250 in interest. However, if you invest the same $1,000 with compound interest at a rate of 5% per year, you will earn $50 in interest in the first year, $52.50 in the second year, $55.13 in the third year, and so on. By the end of the 5-year period, you will have earned a total of $276.28 in interest. So, as you can see, compound interest is a much more powerful tool for building wealth over time. How to get started with compound investing. Now that we understand the power of compound investing, let's explore how to get started and maximize our returns. The first and most important step in compound investing is to start early and be consistent. The earlier you start investing, the more time your money has to compound, and the greater your returns will be. Even small investments made consistently over time can grow into significant sums of money. There are several types of investment accounts that offer compound interest, including savings accounts, certificates of deposit, CDs, stocks, mutual funds, and exchange-traded funds, ETFs. Savings accounts and CDs are low-risk investments that offer relatively low interest rates, but they are a good option for short-term savings goals. Stocks, mutual funds, and ETFs are higher-risk investments that offer the potential for higher returns over the long term. When selecting investments, it's important to consider the interest rates and potential returns. Look for investments that offer high compound interest rates and have a track record of strong performance. It's also important to consider the level of risk that you're comfortable with and your investment goals. Diversification is another key factor to consider when selecting investments. By spreading your investments across different asset classes and sectors, you can reduce your risk and maximize your returns over time. It's also important to regularly review your investments and make adjustments as needed. As your goals and risk tolerance change over time, your investment strategy may need to be adjusted to reflect these changes. Tips for maximizing your compound returns. Now that we know how to get started with compound investing, let's explore some tips for maximizing our returns. One of the most effective ways to maximize your compound returns is to regularly contribute to your investments and reinvest your earnings. By making consistent contributions, you can take advantage of the power of compounding over time. Additionally, reinvesting your earnings means that your money can continue to grow and compound rather than being held in cash or spent. Fees and taxes can eat away at your compound returns, so it's important to take steps to minimize them. Look for investments with low fees and expenses, such as low-cost index funds or ETFs. Additionally, consider tax-efficient investment strategies, such as holding investments in tax-advantaged accounts like IRAs or 401k. Diversification is another key factor in maximizing your compound returns. By spreading your investments across different asset classes and sectors, you can reduce your risk and potentially increase your returns over time. Additionally, consider diversifying across different types of investments, such as stocks, bonds, and real estate. It's important to regularly review your investment portfolio and make adjustments as needed. This means regularly rebalancing your portfolio to ensure that it remains diversified and adjusting your investments to reflect changes in your financial goals or risk tolerance. Real-world examples of compound investing. Now that we understand the principles of compound investing and how to get started, let's look at some real-world examples of individuals who have grown their wealth through this strategy. One great example is Warren Buffett, who is widely regarded as one of the most successful investors of all time. Buffett's wealth is the result of decades of investing in high-quality companies with strong fundamentals and holding onto those investments for the long term. By reinvesting the earnings from his investments and allowing the power of compounding to work, Buffett has grown his net worth to over $100 billion. Another example is Jack Bogle, the founder of Vanguard Group, who pioneered the concept of low-cost index funds. Bogle's investment philosophy was based on the idea that most actively managed funds fail to beat the market over the long term. By investing in low-cost index funds and holding onto those investments for the long term, Bogle was able to build significant wealth over his lifetime. So what can we learn from these examples? One key lesson is the importance of patience and long-term thinking. Both Buffett and Bogle focused on investing in high-quality companies and holding onto those investments for the long term. By doing so, they were able to take advantage of the power of compounding and achieve significant returns over time. Another lesson is the importance of diversification. Both Buffett and Bogle held investments in a wide range of companies and sectors, which helped to reduce their overall risk and maximize their returns over time. So how can we apply these lessons to our own investments? First, we can focus on investing in high-quality companies with strong fundamentals and hold onto those investments for the long term. Second, we can diversify our investments across different asset classes and sectors to reduce our overall risk. And finally, we can focus on minimizing fees and taxes to maximize our returns over time. So, we've covered a lot in this video about compound investing. Here are the key takeaways. 1. Compound investing is a powerful strategy for building long-term wealth because it allows your money to grow exponentially over time. 2. To get started with compound investing, it's important to start early and be consistent with your contributions. Choose investments that offer compound interest and potential returns. 3. To maximize your compound returns, regularly contribute to your investments, minimize fees and taxes, and diversify your investments to minimize risk. 4. Real-world examples of successful investors like Warren Buffett and Jack Bogle show us that patience, long-term thinking, and diversification are key to achieving significant returns over time. So, what are you waiting for? Start investing today and make compound interest work for you. Even small contributions can add up over time, and the earlier you start, the more time your money has to compound. Remember, investing always comes with risk, but with careful planning and a long-term mindset, you can achieve your financial goals and build long-term wealth through compound investing. Thank you for watching, and we hope this video has been helpful in getting you started on your journey to financial success. Don't forget to subscribe to our channel for more great content on personal finance and investing.